few days are known as our accounting period. So, this is last year and this is the current year. So when I prepare my financial statement, for this period, I will be preparing somewhere here. I will not be preparing financial for this period in this period. That's a common logic, no? So when someone is referring current financial year, that is this. You should understand. Then, let's say on this date, annual general meeting is taking place for the company. Annual general meeting is taking place on this date, and on that date only they are approving the financial statement. Who will approve? All the shareholders at the annual general meeting, they will approve the financial statement. Now, so from this date to this date, before the financial statement getting officially approved, there will be so many different activities will take place, isn't it? So the accountants, in the early part of January, they are busy finalizing the accounts. So, initially finalizing the accounts by finance team. Correct? This may take sometime 1 day, sometime 1 week, sometime 2 weeks, sometime 2 months, depending on the size and the complication and the number of transactions and resource. Some company have only 1 or 2 accountants, some company 20 accountants. With all these factors, this time will go like this. Then CFO will approve the draft. CFO is just an employee. He is not a shareholder or he is not a director. So he will approve the draft. After he is approving the draft, then auditors will commence fieldwork to review the financial statement prepared by the team, whether it is correct or not correct, they will check it. So the field work will take place, and then field work will be over. Field work will be over, and then see, theoretically, who should prepare financial statement? Who has the responsibility of preparing financial statement? Accountant. So the management, I don't call it accountant, management. Management has the responsibility of preparing the financial statement. What is the responsibility of the auditor?
Just review.
Review and express an opinion. But in real practical life, what is happening?
Auditors are
More than 99% of the time, this auditor only prepare in the financial statement. This management what they are doing, they will give some company, not all, give trial balance. Majority of the company, even they don't have trial balance also. Right or not? So, in theory, I am just talking in theory, field work will be over. So they will do the audit of the financial statement prepared by the management according to theory. Then auditors will release the first draft. Clear? management. Actually, management must have the draft, but the auditor is sending the draft, and then it will be gone through. It will be checked by the senior finance manager, the CFO, then it will go to finance director, and most of the time, finance director and audit partners are friends. They meet after office hours in somewhere in football ground or in a club or in a bar or somewhere. And then they have this personal relationship. They say, okay, let's finalize this. Then financial statement. Statement ready for approval. One thing you need to remember, who should sign the financial statement first? Auditor or the company representative? Company representative must sign the financial first. Auditor should never sign the financial if any of the financials are not signed by the then it will give an additional liability on auditor. If something goes wrong, collapse. Okay. So financial statement ready for approval. Then the directors should sign the financial. After director signing the financial, auditor should sign the audit report. Not the auditor. Remember also, auditor will not sign the financial statement. The output of the auditor is what? Only the audit report. The financial statement is not an output of the auditor. It's actually like what you call that, it's accompanied. Audit report is accompanied to the financial statement prepared by the company. Okay, now auditor should sign the financial. Now another question, what is the time gap between director signing the financial statement and auditor signing the audit report? What is it? Let's say for example today at morning 9 a.m. director signed the financial statement. How soon the auditor should sign? How long he can wait? Ideally, the time gap must be zero. Meaning, the moment the director sign, auditor should quickly sign. Why? Let's say today morning 9 o'clock you sign the financial. I am receiving the financial tomorrow morning 9. So 24 hours gone. Now, this financial statement we talk about a company or business. Between these 24 hours, if something goes wrong there, and that is not highlighted here, and I am giving a good opinion, then I will be wrong. So, if you have signed it, and you have, that's why audit report at the bottom we are signing the date. Actually, some people advise you should put the time also. Standard only requires to put the date, but some learned women says you should also put the time. Why? Anything can happen after that. So you are not responsible from that point of time. Anyway, coming back to this diagram. Now between these two dates, anything can happen. Now some of these, whatever happens, we call it events. And since that is happening after this date, we call it events after the reporting date. Now some of these events can have a relationship to this period. If any of those events is related to that period, we should adjust it. So we call it adjustable events. And some of the events will have no relationship to this period, we call it non-adjustable events. So, and remember, we are talking about events between these two time periods. But any events here, we are not going to worry about it. So, events are two types. One is adjustable, or sometimes we call it adjusting, and non, like the seat, you know, you can adjust it, move back and forward, non-adjustable or non-adjustable. How to find out what type of events are adjustable and what type of events are non-adjustable? The adjustable events have two conditions. First one, the condition should exist at the reporting date. What I mean reporting date? This date. On that date, some condition, I will give example, okay. Some condition should exist. So that is the condition number one. Second condition, subsequent event should suggest to be adjusted. I'll give an example now. In your balance sheet, under current assets you have receivables. Correct? This receivable is only generally a big business. We will have only one customer or several customers. This is a list of customers. Now these customers is there any guarantee that all of them will pay you? No. Some of them may not pay you. So that's why at the time of we prepare, we also make provision. Correct? So first, if you read the first condition, condition should exist at the reporting date, meaning I have receivables. These receivables can go bad. Chances are there or not? If they are not. So that's number one. Number two, subsequent event should suggest one of the customer became bankrupt. He disappeared. He is not to be seen. He is out of the country. So is there any point keeping this receivable in the balance sheet? No. So when you got to know, let's say my balance sheet date is 31st December 2021, but I got to know in 15th of March. Only I got to know that Mr. X has gone out of Doha and is now living in Ethiopia. So, no point of keeping it, we need to write it down. So this one example of adjusting event. Another example, inventory. I am having inventory. Usually the rule according to IAS 2, inventory should be valued at lower of cost of NRV. This is what we learned. And we have taken a cost. By NRV is higher. Now, see, we talk about the ladies' dress. The ladies' dress, the marketability or the demand among the ladies. Let's say Eid al-Adha this year, the shops brought some dress. Next year Eid al-Adha, the same dress that lady will buy? Never. They want something new, something fashionable. So that dress will become obsolete, slow moving. So then you have to rethink about the way you value the inventory. What is the condition? Cost or NRV, whichever is lower. Now after 31st December, somewhere in April or May, you realize that the market condition for these items have gone down. There is no point of keeping it, we need to write it down. So this is another example. So receivable, inventory are two famous examples for adjusting event. Now what is non-adjusting event? Let's say I have factory, 5 factories. Suddenly, now at the balance sheet date, are we really going to all the time anticipate all the factories will get fired? Or are we going to presume that we always going to have natural disaster? No, right? Although we may have insurance, doesn't mean that we're going to have fire or natural disaster all the time. One of the factories on the 5th of, let's say, May, got fire, burned out. Now the question is it an adjustable event or non-adjustable event? Then you have to ask the question, whether this fire creates a problem to my business. I have 5 factories. One factory totally burned out. Could you still continue the business? If the answer is yes, then it is not an adjusting event. In other words, it's a non-adjusting event. But if you ask the question, could you still continue the business? If the answer is no, then it is an adjusting event. Understand me what I am saying or not? Let's say you have only one factory and it's totally burned down. Could you run the business? No. Then you have to go back to adjusting. But if you have 25 factories, only one burned down. Harmless. So it will not be adjusted. So no condition exists at the reporting date. Number 2, subsequent event will not demand for in addition to all of this, there is one more scenario.
Excuse me.
Yeah.
Can you note the example, those 2 examples down there also? Inventory and
Here inventory and receivable. Here fire in a building. Provided no issue to going policy. There's something called as a customary practice. Although the example is a non-adjusting event, due to the customary practice, we adjust it. Example, dividends. Now when the board meeting takes place, see this diagram, we said that the board meeting takes place here. The board meeting takes place during our accounting period or after our accounting period. Here only they propose the dividends for this period. So this is one good example for a non-adjusting event, but still we need to adjust. That's all. Now we will see example.
so what about this contingency?
Contingency is a different story that we
If
discussed.
court case comes then
Yeah, the court, see, the court case depends. It's based on the outcome of the court case or the opinion of the lawyers. And that is not related to this scenario here. Anyway, let's go to the textbook. Can you try this question?
Second one.
Hmm?
Second one.
this is as a non-adjusting.
As a non-adjusting event.
Second one.
Yeah. This we will discuss. See, you have to be careful. They are again trying to confuse you. Their question is as a non-adjusting event. Among the examples what we have, which of them are not required to be adjusted? A fall in the market price of shares held by the entity as investment. That's see, every year the share price can increase, decrease, so you don't need to worry about adjusting for the last year. So it is one non-adjusting event. So first answer is wrong, last answer is wrong. It should be either 2 or 3. Why? Number 1 should be there. Insolvency of a trade receivables with a balance of 200,000 outstanding at the end of the reporting period. This is adjusting event. So number 2 cannot come. So that's already that comes in. Declaration of the year-end dividend by the directors. It's a non-adjusting event. Generally, although it falls into the it is adjusted, but in terms of nature, it is a non-adjusting event. So number 3, 1 and 3. You are clear or not?
Yeah, 1 and 3 is the answer. Right?
Yeah.
Right. Number 2, why they told?
No, second answer.
Okay. Sorry, confused me. 1 and 3 is
Alas, this chapter is over. Now we are moving on to a very important chapter, cash flow statement. By the way, this chapter what we discussed, standard name. I have written. Stop the video.